Well, guys, Palantir just reported again. They just beat again. Earnings per share of 16 cents, beating the estimates of 12 cents. I give them major credit. Alex Karp finally beat by more than 1 penny, and revenue of $1 billion, beating expectations of $939 million. They're up 2.5% after hours right now, $165 per share. This stock was as low as $5 a share just a couple years ago. It looks like it's now currently an all-time high being hit again. Oh, look at this, 4% up. This thing is smoking. Let's see what the financials that they've reported them yet. They have not posted the actual quarterly results quite yet, but that is very interesting. So guys, we talked about Palantir in the past, and a lot of people think I'm a hater on Palantir. I'm not. I'm a hater on bad valuations. With that said, I think Alex Karp is a psychopath. I think he has his focus in the wrong areas. I think as a CEO, if you watch his actions, he basically tells you valuations at Palantir suck. I believe there hasn't been a single executive buying Palantir stock in the last 1 year. If the company is so incredible and so undervalued, why aren't they doing that? They've all been net sellers. That's kind of an indication to me of, oh boy, what's going on there? But Palantir is an incredible business with 80% gross margin, great free cash flow, which is far higher than the net income, but still 311 times free cash flow and the price to sales ratio of 131. Guys, for those who don't know what these means, expensive as F. Now, with that said, if Palantir is going to grow 100% a year for the next 20 years, these are both really cheap numbers. At some point, the price is too expensive. The question is where. But unfortunately, most people on the internet, they only look at one thing, this. They say, Paul, this company's not expensive. Just look at the chart. Okay, maybe. It's up 567% in the last year. Also not a reason why it's expensive by itself. A stock can go up 500% potentially and still be undervalued. What we care about as principle-driven investors is that every investment is going to end up being the present value of all the future cash flows it makes. What that means is, if you give me $10 today, how much I give you back every year for the rest of time is going to determine your return. The more I give you back, the higher your return. The less I give you back, the lower your return. Or the less you give me up front, that's how it dictates these returns on IRRs. Now, that might sound confusing, but it makes sense. If I told you right now, I'm going to give you $10 a year the rest of your life, or the rest of my life, what are you willing to pay me for that? We don't know things. We don't know how long I'm going to be alive. How long are you going to be alive? Will I even be able to afford it? What if I get into financial trouble and can't pay you the $10? These all factor in. But the less you pay, the less risk you have. If you pay me $10 to get $10 a year for the rest of your or my life, all you have to do is wait out 1 year and get your money back, and the rest of it's all cream. But if I ask you for $1 million, then both of us have to live to 100,000 years old. Not very likely. Do you see what I'm saying here? That's what I mean by every investment is the present value of all the future cash flows. You lay out money today to get returns in the future. Stock's up 5%, $169. In our community, we have 17 members who have voted. Guys, if you're a member of our community, go in here and vote. Only one person has it as a strong buy. Everybody else is a hold, sell, or strong sell. I would be interested to hear what this person views as a strong buy here, why that's the case. Because these are based on the last 6 months. They could have made this rating 6 months ago when the price was a lot lower, $105, still expensive. Now, company number 2, HIMS. Just keep in mind, by the way, guys, I'm going to do my valuation on Palantir right now before we get to HIMS. So let's pull up Palantir's previous times I did it in our stock analyzer tool. Guys, I did some big growth levels, 15, 25, and 35% revenue growth. I did profit margin of 35, 50, and 65. Keep in mind, way higher than they've done. Way higher than they've done in profit. PE, I did 20, 25, and 30, and my 9%, no margin of safety, intrinsic value return. Hit the analyze button. Guys, a low price of 20, high price of 226, middle price of 71. If you pay today's price, you're essentially looking at a net zero return based on that present value. Now, you might sit there and say, Paul, 20 to 226, that's a huge difference. Well, yeah, because we have 10 years of these wide range of different revenue growth and different ranges of profit. But for it to be worth what we're paying today to get even a 13% return, the company's got to grow 35% a year for the next 10 years, generate 65% of its revenue in profit or cash flow, which is literally impossible because if 100% of it was before taxes and they paid 35% in taxes, they would have no overhead. That would be 65%. This is literally probably impossible. That's what I'm trying to get at. And even at the impossible level, and at 30 times earnings and free cash flow, it's a buy right here with a 13% return. This might sound overwhelming. Don't feel bad if it does. You will get the hang of this as you watch more videos. Next company is HIMS. Now, guys, I'm not going to evaluate HIMS because tomorrow on our main channel, we have a video coming out where we evaluate and run the numbers on HIMS. So make sure you watch it on our main channel, Everything Money, youtube.com/everythingmoney to watch the video tomorrow. But let's check out what HIMS has done. Let's pull it up here. Oh, down 9% after hours. They were, oh my God, they missed on revenue and they missed on earnings per share. Revenue missed by 1.2%. They were expected to do $551 million. They did $544. They're expected to earn 21 cents a share. They made 17 cents per share. Wow. I was not expecting that. They are down big after hours. Incredible. Guys, this is a company that's been flossing lately. Look at this chart. 5-year chart up 500%. Incredible, guys. I mean, absolutely incredible. But look at this year to date. Look at this volatility. 25, 70, back down to 25, 30, back up to 7. I mean, this has been all over the board. This is all from the last, since January 1st, guys. January 1st. That's it. Guys, not only did they increase revenue by 48%, Palantir actually also increased their future outlook. That is huge. Let's see what's going on with HIMS. Guys, there's not much on them right now. They haven't even released to their websites, their earnings releases. Guys, remember, every investment is the present value of all future cash flow. This is one of our 5 tenets of principle-driven investing. It's so important if you're new to watching us in this channel to understand these things. Both these companies were hype companies. Palantir went from $45 in 2021 down to $5 a share and has marched itself up back up to $160, $170 per share. An absolute massive turnaround. But don't think that just because the stock is up 35 times, the company's worth 35 times more. We're here to understand that a company's fundamentals and stock price are going to be disconnected a lot. Our goal is to buy when price is below value and only then. The hard part is to figure out what that value is. That's what we're here to explain. But if you want to have a good foundation, click the link below. We have a PDF on our principle-driven investing, the 5 tenets of them. It's a wonderful way of thinking about all investments. I don't care if it's stocks, bonds, real estate, whatever it is. This will help you understand why we buy certain things. If you can grasp this, it'll help make you a better emotional investor and therefore probably get better returns. So if you want that, absolutely free, click the link below. You'll get it to your email within 1 minute. Thank you very much for your time.